Many people believe that investing is only for wealthy, but the truth is anyone can start investing irrespective of their income. In this video, let's understand how to start investing with just rupees thousand sorry dollar hundred beginner's guide. So the introduction is that's a beginner's guide. The purpose is to inspire beginners to take their first steps into investing with small amounts. Investing is no longer limited to those with large sums of money. Modern technology allows anyone to start with as little as rupees 1000 through apps and platforms. Examples apps like Grow, Zeroda, and Robinhood make the process simple. The earlier you start, the more time you give your money to grow. The compounding effect if you invest rupees 1000 at 10% annual return, it doubles approximately every 7 years. Building financial habits early creates discipline and reduces dependency on others later in life. Key objectives of the video is to provide clarity on different investment avenues like mutual fund, stocks, and fixed deposit, help viewers identify which options align with their goals and also to build the confidence. So why we have to start investing early? Because of the compound interest. If you start investing early, the compound interest keeps adding, and at the long term, you get a lump sum, huge lump sum money. The power of compound interest. Investors grow exponentially as returns are reinvested over time. The earlier you start, the longer your money has to compound, resulting in higher growth. So, what's the example? In initial investment, rupees 1000, annual return, take it as a 10%. After 10 years, if you have invested rupees 1000, that becomes 2600 without adding more money. This is just a simple example. The financial independence goals, small, consistent investments. So, why you have to start investing early? Because of financial independence goals. Small, consistent investments. Regular contributions create significant wealth over time. Example investing rupees 5000 monthly from age 25 can lead to financial independence by retirement. So by the time you retire, take it as a 60 years, so you get some crores of money in that because it's a compounded interest. Early investors who began with small amounts and achieved long term financial freedom. Understanding the investment options. So, why is it important to understand the investment options? It's very important because to grow your wealth, achieve your financial goals, to build confidence, and avoid the pitfalls. Choosing the right options can help your money grow for you. Achieve financial goals, education, travel, owning a home, or early retirement. Build confidence, helps you make informed decisions instead of guessing. Avoid pitfalls, prevent losses by understanding risks and rewards of each option. Low risk options. So, what are the low risk options? Safe and stable. Savings account with high interest, easy to access your money anytime. It's having a high liquidity. You can open an account with the HDFC Bank, Axis Bank, ICICI Bank, or any bank. High liquidity. Example, earn 3 to 4% interest annually. Use for emergency funds. Fixed deposit. Lock your money for higher returns. 5 to 7% annually. Idea for people who don't want to take risks. FDs often offer higher interest than savings account. So these are the low risk options. So now we'll consider moderate risk option, that is a balance approach. So mutual fund. So what are the types of mutual fund? Equity funds invest in stocks for higher returns but involve risks. Debt funds safer invest in bonds and fixed income instruments. A mix of both for balanced growth. Start SIPs, small monthly investments with apps like Grow or Zeroda. 500 invested monthly in a mutual fund can grow significantly over 10 years. Index funds mimic the stock market. Example Nifty 50 or Sensex offer diversification with lower costs. So, what are the benefits? Less risky than individual stocks, ideal for beginners. High risk, high reward options, potential for big gains. So, stocks buy shares of companies and earn profits as their value grows. Start small, focus on blue chip companies like TCS, Infosys, or Reliance. Tools use stock screeners or follow financial news for research. Invest only after learning the basics. The next is cryptocurrency. High potential but extremely volatile. Popular examples Bitcoin, Ethereum. Only invest what you can afford to lose. Other good options for students to start with. So, what are the other options available for students to start with? Recurring deposits. Save a fixed amount every month and earn interest. Great for building the habit of saving. Gold investments. Buy gold as an asset, physical or digital, or low risk and useful in emergencies. EPF, Employee Provident Fund, Public Provident Fund, long term tax saving investments for the future. So, the step by step guide to start investing. Define your goals. The second step is choose the right platform. The third step is open an account. Allocate your funds. Start small and scale gradually. Define your goals. Short term goals. Example vacation, emergency fund. Investment focuses, you'll be focusing on low risk and liquid options. These are the short term goals. Long term goals. Examples include retirement, buying a property. So, investment focus should be on a moderate to high risk options for higher returns. Align your investment with your goals. Choose the right platform. Popular platforms are in India, it's Zerodha, Grow, Paytm Money. So, the global is in US, it's Robinhood. Global is eToro. Want to check? Look for low commission rates. User friendly apps for beginners. Reliability ensure platforms are secure and trusted. Start with platforms offering educational tools. Now, the next step is open an account. So, you have to first open a DMAT account setup. So, what are the required documents? PAN card, Aadhaar card, bank account details. So, the steps are register on the platform, complete KYC, know your customer verification, and link your bank account. Ensure all information is accurate to avoid delays. Allocate your funds. Simple portfolio for rupees 1000. Example, invest rupees 500 in a fixed deposit, 300 in an index fund, and 200 in a blue chip stock. So you are diversifying here in fixed deposit, index fund, blue chip stock. Adjust allocation based on your risk tolerance. Start small and scale gradually. First begin with small amounts, then reinvest that returns. Again, increase contribution. Again, focus on consistency and not for perfection. Learn how investments work without risking too much. Reinvest returns. Grow your portfolio by reinvesting your earnings. Increase contributions. Add more as you gain confidence and knowledge. Focus on consistency, not perfection. Monitoring and managing your investments. So, how can you monitor and manage your investments? By tracking your portfolio, adjusting your allocations, long term perspective. Track your portfolio. How to track? Use investment apps like Zerodha Grow or Paytm Money. Alternatively, create a simple spreadsheet to log investments and returns. When to review? Conduct a quarterly review of your portfolio. Ensure that investments are still aligned with your financial goals. Set reminders to stay consistent with the tracking. Adjust allocations. So, why you have to adjust allocations? Rebalancing ensures your portfolio stays balanced, and aligned with your risk tolerance. When to rebalance if one category outperforms or underperforms significantly. So the example includes move profit from high risk investments into low risk ones like FDs or bonds to secure gains. If there is any a low in the market, that time you can move the profits from the high risk investments into low risk ones, FDs, to secure gains. Stick to your original strategy and avoid emotional decisions. Long term perspective. So avoid panic. Market downturns are temporary. Don't sell investments out of fear. Remember, volatility is normal in the short term. So stay focused. Keep your eyes on long term objectives like building wealth for retirement or property purchase. Review historical market trends to understand recovery patterns. Educate yourself continuously. Stay consistent, diversify, avoid emotional decisions. This step emphasizes the importance of learning about personal finance. Recommended books: The Richest Man in Babylon focuses on ancient financial wisdom like saving, investing, and controlling expenses. Rich Dad Poor Dad explores a different mindset towards money and investing, emphasizing building assets. Stay consistent, building good habits. Systematic investment plans, regular automated investments in stocks, mutual funds, or other assets. Benefits: ensures consistent investing regardless of market fluctuations. Power of compounding allows your investment to grow over time through the compounding effect. Regular contributions, even small consistent contribution, can significantly impact your long-term financial growth. Diversify. Spread your investments across the different asset classes to minimize risk. Asset allocation. Distributing your investments among various asset classes like stocks, bonds, real estate, and gold. Different asset classes react differently to market conditions. When one asset class performs poorly, others may perform well, cushioning the overall impact on your portfolio. Avoid emotional decisions. Short term excitement or fear surrounding market events, often leading to irrational buying or selling. Avoid making impulse decisions based on fear or greed. Stick to your investment plan and long term goals. Key takeaways: start small, even if you are investing, saving 1,000 rupees. Over a long term, it leads to some lakhs and crores of money over a very long term, maybe for 30 years or 40 years. If you're investing 1,000 rupees monthly, at least minimum 1,000 rupees. Invest regularly. Consistency is key. Diversify wisely. If you invest, you'll get some lakhs of money over a long time for 30 or 40 years. So if you like my video, please share it with others, give a thumbs up, subscribe so that you can watch more videos. Click the link below and join for my free webinar. You'll be getting a ebook in that, and start growing your wealth